Good afternoon, everyone. This is Bob Dole from Solution Driven Wealth, and today is Friday, April the 3rd, 2020. Welcome to our webcast that we're doing today on the way forward after the coronavirus. Again, we are in extraordinary times, and we just really want to record this as a way to get great information out to our clients. You matter to us. And obviously, this has been an extraordinary time in our country's history. We've never really quarantined ourselves and or our economy quite like this before. So it's having an impact on the markets and really the predictability of the markets for that matter as well. So what we were hoping to do today is really to give you factual information regarding what's transpired, and more importantly, about what's going to come as we move along and get through this crisis. And we do believe that we will get through it together. So before we get into the data and some of the points that we want to make today, is that we certainly want to convey to you that we care about you tremendously. We care about the health of you, your children, your parents, your aunts, your uncles, your extended family, and those in your community. And that is the most important thing. Our goal, again, is for you to be the most informed, knowledgeable person in your family, neighborhood, community, church, or synagogue. We also all are very hopeful that, as Americans, this event is going to galvanize and bring out the best in us. And that is the hope longer term. We also, I think, should all be thankful, and I think we can be uniformly thankful to our first responders, those who are our doctors and nurses and all those in the healthcare community really helping on the front lines with this crisis, as well as those people in places like our grocery stores and associated food business and supply chain for all the work they're doing. I think as Americans, we can contribute to the recovery in this way, in that we can be our nicest selves during these challenging times, as it really doesn't cost us a penny. When things get back to normal, and they're going to get back to normal, please visit your local businesses and be a patron. So having said that, some of our goals today is we are going to talk about the coronavirus economy, what was in place before and where are we now, the history of economic volatility and other times of uncertainty, and the stimulus package that was passed recently. It's important, I think, to go over that. We are in extraordinary times, and to say it bluntly, the stimulus package was an extraordinary and is an extraordinary stimulus package, truly record-breaking on a lot of fronts. And we are going to have a little quiz during kind of a dreary time in our country's history. Let's talk about factual data, and we can have some fun with it and make you informed. And again, that is our goal. So having said that, let's get into some of the basics. In January of this year, the Wall Street Journal had a forecast of 60 different economists, and none predicted a recession. That is a big zero. The global forecast for those, at least for US GDP growth, was about 1.8%. While that's a bit slower than it had been, certainly pretty healthy, and certainly healthy historically if you look past the last 10 years. So pretty good in that respect. But then obviously the world changed about 4 to 6 weeks ago as the coronavirus spread from China to Europe, and then of course to the United States. And here is where we are now. However, historically, volatility in the markets, and we certainly didn't expect this volatility from this event, we didn't even expect this type of event to occur, has occurred historically in our country, at least in terms of the markets. So historically, if we look at declines, we have a decline of about 20% or more about once every 3.5 years. That does happen historically. And we've had declines of about 15% or more once every 2 years. So these events do occur with rather regularity and some with levels of frequency. However, what I think would be helpful, and this is where we can have some fun, if you will, with the quiz, go back in time and take a look and say, hey, How many times in that 93-year history did we incur a loss of 12% or more? How many times did we incur a loss of 12% or less? And how many times have the market gained 0 to 12%? And how many times has the market really encountered a gain of 12 or more percent? We'd like you to fill in the box. So if you have a pad or pencil, please make this matrix where you put your guess. We'll give you the actual numbers later in our presentation, and we'll also give you the probability. And why is this important? It's important for a couple of reasons. Daniel Patrick Moynihan, many of you may remember, was a senator from New York, 4-time senator from New York, and an ambassador, and quite an orator, and had a way with words. And once he said that everyone is entitled to their own opinion, but not everyone is entitled to their own set of facts. So this is factual data that we'd like to bring to you. So again, we make you educated and that informed individual in your community. So we'll get to that in a few minutes, but let's go over some changes that are occurring. So some things that are occurred here are part of the stimulus package. Now, the stimulus package itself has been enormous, and the stimulus package is called the CARES Act, and that stands for the Corona Aid, Relief, Economic Security Act, or the CARES Act. It is a $2 trillion bill, a massive bill on top of other bills that have already been passed. To put it into perspective, this is 3 times the size of the aid package, the TARP program that was passed in 2008 and 9. So it is a massive bill, and it encompasses many different areas. The areas that it encompasses are aid to individuals, about $560 billion. Aid to large corporations, about $500 billion. Aid to small businesses, about $377 billion. Aid to state and local governments, about $340 billion. $154 billion will be added to public health initiatives, and $70 billion to education. It is a massive, massive bill, and we're going to parse through some of the important aspects of it in a few minutes. Now, part of the stimulus package bill was a portion of it is called the Payroll Protection Act, the PPP. And really, this encompasses the covered dates are from between February 15th to 6/30. And the entire crux of this Payroll Protection Act is to inject as much capital and resources into the markets as quickly as possible. Essentially, get it into the hands of individuals who, the theory is, will spend it. Again, 70% of our economy is consumer driven. 70% of our GDP is consumer driven. So let's talk about that and how we can get that money back into those hands. And that's really exactly what the stimulus bill is designed to do. Now, I've been on calls on a continual basis with some of the largest money management firms in our country. I was on the call yesterday with Capital Group or American Funds, and also yesterday with Goldman Sachs. Both firms are independent firms of one another, and both concur that really the Stimulus Act and this Payroll Protection Act does exactly what was called for. Essentially, our economy has been sequestered or quarantined, and we really need to inject as much capital into the economy quickly as possible. This will have the most impact. Infrastructure bills and other types of bills will have a delayed reaction and will not get us through this crisis. So the type of stimulus that was passed, while we don't think it will be the last bill passed, we do think it's very important, and we concur with those findings. Now, what's really important about this is that for small employers, they'll be able to include salary, wages, and commissions into this type of program, and we'll talk a little bit more about that. But many of the elements of compensation are included in the act, and they can be used for that. How the process will actually work is the program is going to work through the Small Business Administration, and the program really begins today in terms of how you file. You're going to deal with your local bank. So you do want to confirm that they're participating in the program. And it really doesn't matter if your business can't even obtain credit elsewhere, meaning if you would have been denied for credit and couldn't get it, it has no bearing on you being eligible to participate in the program. These are going to be non-recourse loans, meaning loans that you don't have to pay back, which is extraordinary. We've never had a program quite like this. And these are really designed for expenses incurred 8 weeks from loan origination. So if the loan is originated on April 3rd, the concept is to get that money into the market no later than June 3rd, okay? And really 75% of the money that you're collecting in this circumstance that the small businesses are collecting, 75% of that has to be put out to employees for wages. So this is the idea to discourage people going on unemployment. 25% can be used by small employers for rent and other types of lease arrangements that they have, utilities, things of that nature. You may have heard is that the federal tax filing deadline has been extended to July 15th of 2020. Up until yesterday, New Jersey was still on the fence about this. It has also extended the deadline for state filing of taxes until 7/15 of 2020. We are of the opinion that you'll be able to make contributions up until that time, though we are recommending that you make them sooner. As in earlier broadcasts and videos that we've done, we feel that the market is compressed right now and depressed in terms of prices, and that we obviously want to do is buy into this market at this time at lower prices. Again, we are looking longer term, not just short term. So we are long-term investors, as really most of our clients are. So we are very much concerned about being in the market. It's time in the market, not out of the market, that will make you money. As far as the individual taxpayer relief program, we're going to highlight some of the key elements of this. Again, these are just some of the key elements. They're not the entirety of the bill. But some of the things that we're looking at are some tax credits that you'll receive, credits for children under the age of 24. These will be phased out generally for incomes for married filing jointly above $150,000. There will be a complete waiver of required minimum distributions for those above the age of 70.5 as of last year. Again, remember, under the Secure Act, the retirement age has changed to 72, so you weren't required to take those distributions anyway if you turned 70.5 on January 1st or later. So we also, there's a 5-year rule, so if you were taking a distribution from an inherited IRA under a 5-year basis, then you can skip a year, meaning this year will be completely skipped. It is undetermined right now if you're taking a distribution from an inherited IRA, if that will be part of the bill. But what we're recommending in this set of circumstances is delay taking that. We have more than enough time to make up for that, and we can delay and take that in November of this year. So we'll talk about with those people impacted by that bill later in the year about that. But again, some of the other planning techniques I do want to highlight. If your market value is depressed temporarily here because of this market dislocation, then you might want to consider a conversion to a Roth IRA. Why? Well, the market value is down. And again, for some of the reasons that we highlighted in our last presentation, under the Secure Act, which was passed on December 20th of last year, non-spousal beneficiaries will have to begin to take out some of those distributions over a 10-year basis. So they'll have to be exhausted within 10 years. So if the value is already depressed now, it can make some sense to do that for your beneficiaries. It could also make some sense to do it for yourself. So we want to talk to you about that on a one-on-one basis. But again, strategically, it could be an advantage to do that from a tax perspective. Other strategies, the concept of making lemonade from lemons, so to speak, is the idea of tax loss harvesting. Now, we do this typically for clients in the fourth quarter of every year. However, in this set of circumstances, because the market has been so compressed and depressed for this period of time, we have gone ahead with many, many of our clients and already harvested losses or in the process of doing so. Why? Let's go through a basic example, just using one type of security as our example. Let's say, for instance, that we owned Google and Google's value was $10,000, or let's make it more exciting, $100,000. And for whatever reason, Google's price was so depressed that it was down and my account was now worth $50,000. I still like Google, but the market dislocation has really created a paper loss of about $50,000 on paper. But that doesn't mean anything if I don't realize the loss. How can I benefit from this set of circumstances? Well, what I might be able to do here and could do is realize that loss, meaning sell Google. I still might like Google, and I don't want to be out of the market because, as we know, the market's really been moving in with a lot of velocity to the upside on many days here. So we don't want to be out of the market and miss. So what I might consider doing is buying either another tech type position or perhaps another tech ETF and or a mutual fund. As long as I don't outright buy Google or the exact same position, then I do not violate what's called the wash sale rule, meaning the IRS would disallow this loss if I bought Google back within 30 days. So in this set of circumstances, I have booked the loss, I have it on paper, and I can use that capital loss against any other capital gains that I might have if I sell another stock or a security, or a fund or an ETF, anything like that. I can use that in perpetuity going forward until that loss is exhausted. I can also use the loss against ordinary income to the tune of about $3,000 a year in perpetuity. The loss never goes away. So it is like a get out of jail free card from a tax perspective. Now, after that 30 days is up, I can go back in and buy Google. And if I go ahead and say I don't have any other losses, but let's just say hypothetically, I eventually sell Google and my account value is worth $150,000 a year, then that loss will be offset, or that gain will be offset by my capital gain. Okay? So that means I will incur absolutely no set of taxes in this set of circumstances. So a very powerful impact in this set of circumstances from a tax perspective. Also, we want to talk about the history of recessions and recoveries. Folks, I know it's a very difficult time right now, but right now we're looking very close in terms of our perception of the markets. Everything is dire, everything is negative. We're getting bombarded from the news media and whatnot about these set of circumstances. So let's go back in time to past issues where we've had recessions in our economy. So I can go back on this chart to 1974. And in this set of circumstances, those were the odd and even gas days. You might have remembered those recession days where you had to stand in line with your car and wait to just get gas. That was a very deep and impactful recession. But I will point out, after the recession was over in 1975, the market was up about 26%. If we go back into the downturn of the late 1970s, early 80s, when Carter was president and then Reagan was elected as a result of that, really, again, we had some very difficult times, but then the market really popped and really did very, very well there. And then we had a brief downturn in the late 80s. And then we had an expansive recovery. Remember, it was George Bush that was elected in '92. Clinton was elected, and it was the economy stupid that time. Well, during that phase, during the last year of Bush's presidency, we suffered a bit of a recession, a short one, a very quick and sharp one. Well, Clinton was elected, and then we had a very expansive economy. Again, probably a little too far. We got a little silly at the end where a lot of those technology stocks that didn't make any money really probably went a little bit too far, and then we sold off. We had the tech wreck, if you call it, and a recession, and of course 9/11 took place then. And then the Fed stepped in, kept rates very low, and then we have an expansion until about early 2008, and then really a pretty sharp downturn in 2008, another very profound expansion. So, and then you see just this red line on the right here where we've gone down a bit here, not anywhere near some other recessions. So the point that I'm making is that if we look historically, bear markets occur once out of every 6 years or so, historically. Our expansion lasts 72 months, and the growth far exceeds the downturn in the bear market. So I know everyone is looking very profoundly at their portfolios right now and saying, what in the world happened? But if you move to cash now, your likelihood of missing the upturn is profound and will have long-term implications to your portfolio. So we think tax loss harvesting, perhaps making some modest adjustments to your portfolio to take advantage of the situation makes sense. Moving to cash is not a long-term strategy. And we don't feel it is, and it has proven never really in our history to be a long-term strategy. On the other hand, I can't tell you that when exactly we're going to come out of this. It really is contingent on, I think we all agree, on the number of new cases from the coronavirus starting to ebb and starting to decrease, and us developing some better therapies than are in place right now, and perhaps even a vaccine to quell this going forward. But we're going to come out of this. And my concern is that with money on the sidelines, you'll miss much of the impact of the recovery. And again, in conversations that we've had with many money management firms, most notably recently, Capital Group or American Funds, they've been around since the 1930s, and also Goldman Sachs yesterday. These are two firms we get a lot of research from. Both are predicting recoveries in Q3 and Q4 of this year. Goldman's forecast, believe it or not, is the S&P to finish at or above 3,000 by the end of the year. It's trading right now around 2,500. So that's a pretty big move to the upside from here. It doesn't mean it's set in stone that it will happen, and this is just Goldman's view, but both firms are predicting a pretty profound and steep recovery on the other end. So that's actually optimistic. What are some of the other reasons that will point to how we will come out of this and why we will come out of this? I think earlier we pointed to the stimulus and the fact that both Congress and the Federal Reserve, who is inserting a tremendous amount of liquidity into the markets, as well as Congress passing earth-shattering and record-shattering legislation to inject a tremendous amount of capital back into the markets and stimulus. I think that is one of the reasons we'll do well out of this. I think the other thing too is demographically, this chart is pointing to a very optimistic tone. There's a lot going on to this chart, but essentially what this is recording in this chart is the working populations of both Europe in the upper left quadrant, Germany on the upper right, then we have Japan in the middle left, and China on the middle right. What you're seeing here is that their working populations are going to do what? This is recorded that peak line is 2015, and we're moving forward from that all the way out until 2099. Based on current census data and information, this is the working populations of each of these respective geographic and economies around the globe. You can see that in every instance, the working people will actually diminish tremendously. What's the one exception? The one exception is the United States. Our working population is expected to increase pretty profoundly, and that bodes well for a very robust economy. So we feel confident about this long term. I know, 2099 is not what everyone is interested in talking about today. They're talking about the next day, the next week, the next month. Folks, none of us can predict that. But what we predict or begin to look at and say, hey, are we going to be in a better place at the end of 2020 or in a worse place? And what is things going to look like in 2021? Are we going to be in a better or worse place? I think most of us agree that we'll be in a better place. But I know it's difficult when we're getting bombarded by the media every day. So I think what we need to talk about is the idea of, quoting, waiting to invest until it feels better. I don't agree with that philosophy, and here's why. We've done some studies on behavioral finance, and I very much understand that a good percentage of our client base is somewhat older, certainly in the 55 to 90 age range. And that's our client base. That's a predominantly large portion of our client base. But here's how we look at things. We don't generally invest for clients on a short-term basis. That's not how we invest. And what happens is, and we've studied this through past downturns, is that the market starts to turn down and we say, well, this is only temporary, we'll get by this. And then when the markets are in the throes of really a cratering event, it's time to sell and clients may get out. Most do not. Most of our clients, I think, know better than that. It's not a time to sell at that moment. And when the opportunity is the greatest, what happens? Well, those people that sell wait, and they wait, and they wait. And then when they start to see some recovery, they say, well, perhaps it's time to reevaluate. And then we see on the left-hand side of this chart that it's time to the buy. But what has happened then? They've missed a substantial portion of the recovery. Instead of being a long-term investor, they reacted to short-term events with short-term decision-making. And that is not how you make money in the equity markets or even the fixed income markets. For that matter, the fixed income markets right now have been very much dislocated. The Fed has done a tremendous job, in my opinion, of adding a tremendous amount of liquidity to those markets, so that I do feel that they will normalize over the next 6 to 12 months. Goldman feels that there's actually tremendous opportunities in the muni market and also in the corporate bond market, even in high yield for that matter. They feel much of the damage has been done. So the bond market actually may, at these prices in certain categories, with the exception of maybe government bonds, may represent actually a tremendous opportunity to make money. So again, if you're on the sidelines or thinking of waiting to add money, we feel it's time to get into the market and look longer term and participate. Why is that true, and why does it matter? If we look at those quiz results, which I promised you earlier, and that matrix that you wrote down on your page, let's talk about the facts. Again, our own set of facts, not opinion here. Historically, over the last 93 years, those years in which the market downturn was 12% or greater occurred just 7 times, or 7 years out of the 93. I think that probably surprises many people. A small loss, which would be 0 to 12%, occurred about 18 years, or about 19% of the time, 19.5% of the time. However, the small gains, which encompass gains of those between 0 to 12%, occurred in 20 of those 93 years, or about 21.5% of the times. The big gains, the gains above 12%, those gains occurred in almost 52% in terms of percent of those times, or 48 years, greatly dwarfing those with a big loss. So if you're waiting for the time to be right, the percentages and the probabilities are not on your side. A 6 times level to get a better return in big gains than you would from a big loss. So again, we think we move higher from here. We feel much of the damage has been done and that capital should be deployed appropriately. The other thing to point out is that I just said a few minutes ago is that the media is not your advisor. Right now, you're going to be inundated with a lot of data about how poorly the economic numbers are, unemployment, gross domestic product. Of course, the numbers are going to be bad. That should come as a shock to no one. Unfortunately, you'll see the media dwell on these figures. Our goal is to make you informed with actual data, not with hype, but with actual data about what's occurred historically. So keep in mind that when you have a portfolio that's been impacted by this, and essentially every single portfolio has been, it goes without saying, do not be swayed by short-term events to your long-term plan. If your long-term plan is retirement income over a gradual distribution percentage over many, many years, this should not change that view whatsoever, okay? These are short-term events. As I've said earlier, we think that you're well positioned in the right country, God bless us all, to recover from this. So let's take the key takeaways from this. This downturn has been different. Why? Because it's not market related at all. It's completely healthcare related. And the government took the steps, I think everyone would agree, necessary to protect its population. However, we're going to come out of this, and history is on our side. We have the best system on the planet to reward ingenuity and creativity. You know, companies are going to flourish during this new economy. We've seen some of those. Some of the companies that are able to operate remotely through Zoom conferencing and GoToMeeting and those types of economies. And maybe some of the delivery systems that we've had now in terms of our supply chain are going to benefit from this. But not every business and not every subsector of a business will do well. This happens during every single downturn. During the financial crisis, some companies made it, and frankly, other companies did not. So those with strong balance sheets, we feel in this economy, will do better. They'll buy and gobble up essentially some of those companies that were highly over-leveraged and perhaps didn't have a good, solid management team and or business plan. So again, we don't think those businesses will completely go away and the market capitalization won't go away. It will just be merged into larger entities, and that's why we typically favor some large cap companies in this type of recovery. Also, to reiterate, we said to you earlier, we have by far and away the best demographics of any industrialized economy on the planet right now. So we really feel optimistic about that. We like how we're positioned, and we feel that both the stimulus and added stimulus to the economy will be beneficial in the intermediate and to long term. Lastly, and most importantly, we care about you. For many of our clients, we worked with you for 20 to 30 years. You very much matter to us. And for our new clients and perhaps people who are considering working with Solution-Driven Wealth, you matter to us too. So if you'd like to get any more information that we send out to all of our existing clients on a regular basis, please let us know. If this video has prompted you to ask some questions or have some questions for us, you know how to reach us. Our entire team at Solution-Driven Wealth is thinking about you and your family and your extended family, and we're here to help you get through this, and we will get through it. We plan on sending you additional updates as this situation goes along, and we want to, again, keep you very, very informed. Lastly, it's an honor to work with our clients. I consider it a calling, and it's very, very important to me that you're kept informed about how the markets are performing, how your portfolio is performing, and the way forward. If you have any questions whatsoever about anything presented here today or about your specific situation, please give us a call. We're here to serve you. Thank you very much, and have a wonderful weekend.